In today's video, I am going to be sharing with you 5 top trading strategy that every beginner need to learn so as to start making money faster in the forex market. Are you a newbie trader who is just starting out as a trader, or you have been in the industry but you don't know the strategy that you are going to use for trading? Stay tuned because I have good news for you. In this video, I will be sharing with you top 5 trading strategy that every beginner trader should understand and master so as to start making money consistently in the forex market. The advice I have for you guys is to make sure that you watch this video from the beginning to the end. Do not skip any. Make sure you watch the video from the beginning to the end so that you will understand everything that this video is talking about. So let's dive straight into the video. So we have different trading strategy, but this top 5 trading strategy is very simple for beginners to understand, and I'm going to give you some examples so as to know how you can trade it profitably. So the first one we have is the trend following strategy. Most of you know about the trend following strategy, and they say the trend is your friend. So in the trend following strategy, you are only meant to trade in the direction of the trend. You know that there's what we call a market structure. A market structure is when the market is in an uptrend, downtrend, or ranging. But what you are looking for is when the market is in a trend, either in an uptrend or in a downtrend, so that you can trade in the direction of the trend. So trend following is one of the basic trading strategy that newbie traders should master. So let me give you an example of how you can be able to trade this strategy profitably. So it depends on the type of trader you are. For the sake of this tutorial, we're going to use day traders for instance. So we are making use of the 15-minute time frame. So the first thing you have to do is to open your chart. It depends on the pair that you are trading, but for the sake of this tutorial video, we are going to be using gold. That is the pair we are going to be using for this tutorial, but you can use any pair that you want, right? Then we are using 15-minute time frame for this tutorial. You can use any time frame you like. You can use 1 hour time frame, you can use 30-minute time frame, but for the sake of this tutorial video, we are using 15-minute time frame. So we are trading on gold and we're using the 15-minute time frame. So like I said, trend following is a trading strategy where a trader trade in the direction of the trend. What you do is you trade based on pullback. If the market is in an uptrend, you only trade when there is a pullback. When there is a pullback to support, that is where you take your buy trade. And if the market is in a downtrend, you only trade when there is a pullback to a resistance level. That is where you expect to take your sell trade. So that is how trend following work. So the first thing you have to do is to identify a trend. That is the first thing you have to do, to identify a trend, to know the direction that the market is going. So first you zoom out the chart for you to be able to get a clue of where the market is going. So now by zooming out the chart, if you look at the chart, what is it telling you? The market is clearly in an uptrend because the price is making series of higher high and higher low, breaking previous highs. That means the market is in an uptrend. So as a newbie trader who is trading based on trend following, what you have to do is to pay attention at the lows, because that is where you will be taking your trade. So you know that each time the price goes up, it tends to make a pullback right before the uptrend continues. So that pullback is what you should be looking at. So I'll give you an example of where you can find these pullbacks. So now you can clearly see that the market goes up. Let's start from here. The market goes up here, then makes a pullback here. This is where you're expected to take a buy trade. This is where you're expected to take a buy trade, right? This is where you're expected to take a buy trade when there is a pullback. So the market goes up, come back, market goes up, comes back, goes up again, comes back, goes up again, then came back again to test this level, goes up, comes down, goes up, comes down again to test this level, then finally started going up. So So you can see that the market tested it 1, 2, 3, 4, 5. So 5 times. So this is clearly where you are expected to take what? A buy trade. Now another place you can take your buy trade is previous resistance level. So this is what we call previous resistance level, because whenever the price breaks above a resistance level, that resistance level automatically becomes a support level. So this is where you're expected to take your buy trade, because this is where the price is unable to break through, right? So whenever the price comes close to there, it get rejected. You can see that the price came close to there, get rejected, comes close to there, get rejected, comes close, get rejected, come close, get rejected, until the price finally breaks above it. And then what happened? The price now came back to retest the level, right? Previous resistance level, now turn support. So this is another place where you're expected to take your buy trade. Remember, you are trading in the direction of the trend. So you are not selling, you are only buying because the market is clearly in an uptrend. So you are only looking to buy. Then another place where you can take your buy trade again is here. You can see that we have 1, 2, 3 and previous resistance. So this is another place you can take a buy trade, right? Because the market came to this point, got rejected, right? Break a little below, got rejected, and then breaks above it. So this point also becomes what? An area of value, because this is a previous resistance level where the market got rejected, and when the market breaks above it, it now becomes what? A support level. So you can see that the market came here, got rejected, comes again, got rejected, and then start going up. So if you're able to get an entry at this point, right, a buy entry at this point, you'll be able to ride this trend. So this is another level where you can take your buy trade. Remember, you are trading in the direction of the trend. And this is another level where you can take a buy trade. This is another level where you can take a buy trade. This is another level where you can take a buy trade. So you can see that this is the level where the price is getting rejection. So as the price goes up, it comes here and get rejected, goes up again, comes here and get rejected, goes up again, comes here and get rejected, goes up, then comes back here and get rejected. So you can see this is the entry, this is your entry, this is your entry, and this is your entry. So this is what we call trend following, right? This is what we call trend following. You trade only in the direction of the trend. So for the fact that the price is going up, you wait for a pullback. So these are the pullbacks where you take your buy trade. These are the pullbacks where you take your buy trade, and these are the pullbacks where you take your buy trade. So as a trend follower, you only trade in the direction of the trend. So this is an example of an uptrend. So you can do the same in a downtrend. For a downtrend, the market is going down, you wait for a pullback towards what? Resistance level, and you take your sell trade, just the opposite of this uptrend. So that is how you trade based on trend following. So that is the number one strategy that you can master as a newbie trader. The next strategy you can master as a newbie trader is the breakout strategy. A breakout strategy is when there is a consolidation for a period of time and price finally breaks above the highs or the lows, right? So if the market is consolidating, like the market is in a sideways ranging, you simply exercise patience to see the level where the price can break above, because if the market is in a range, you can visibly see the up and the down, right? Because the market will tend to receive resistance and tend to receive support. So we'll be trending on a range bound. So as a breakout trader, you exercise patience and wait for the price to break either above the resistance level or below the support level before you can take action, right? So that is how you trade breakout. So a breakout trader will always be patient to wait for explosive breakout. And when there is a tight consolidation, right? When there is a tight consolidation, that means that the market is going to break too high. Like if the consolidation is too tight, like it is too tight. You know what I mean by too tight? When the space for the for the resistance level and support level is too tight, in the sense that you can't trade support and resistance because the range is too tight. It means that the market breakout is going to be explosive. So in this scenario, you don't trade the support and resistance. You simply exercise patience and wait for a breakout. So once a breakout happens, you can follow the direction of the breakout. Sometimes you can wait for the price to break above a resistance level and then comes back to test the resistance level, which has automatically becomes a support level for you to take your buy trade. Let me see whether if I can find an example for you so that you understand how this breakout is, how you trade this breakout. Let me look for an example so that you understand how to trade breakout. First, like I said, if you want to trade a breakout, first you have to wait and look for what we call a consolidation, where the market is making consolidation. That is the first thing. You first look for a consolidation before that. So now let's assume this is it. Let's use our okay. So here, this is an example of what I'm talking about. All right, so here you can clearly see that from this point to this point, the market was ranging, right? The market was ranging, tends to receive resistance here, receive support here, receive resistance here, receive support here. So in this scenario, you can see that here the market was ranging, right? The market was consolidating here. So as a breakout trader, what you simply do is to plot out your horizontal line and draw the support level and also draw the resistance level. So this is the resistance level and this is the support level, right? So what you are doing is you are waiting for a breakout. If the space is large, you can trade the resistance level and the support level. Like if the price comes to resistance, you take a sell trade, and if price comes to support, you take a buy trade, based on if the space of the highs and the low are wide. But if it is not wide, if it is tightened, you can just exercise patience and wait for a breakout, right? So you can see that here there is an equilibrium between buyers and sellers. That is why when the price comes to resistance level, sellers push it down, and when it comes to support, buyers push it up. So here there's equilibrium until there is a breakout. So in this scenario, the buyers were able to defeat in this scenario. So here you can see that the price eventually broke above this resistance level, right? So this is what we call a breakout. So now what you simply do is, this is the candlestick that caused the breakout. This is the candlestick that caused the breakout. So you simply wait for it to close. You simply wait for the candlestick to close. So once this closes, you can then put your buy trade here. Then your stop loss will be below this resistance level, not on support level. So this is what we call a breakout. You simply wait for a breakout and wait for the candlestick that caused the breakout to close for you to confirm the breakout. Then you cannot place a buy trade here. Then your stop loss will be below, and then you can either ride the trend or have a fixed take profit. So this is how you trade breakout for breakout trading strategies. This is how you trade it. So the next one we have here is what we call the moving average. The moving average is almost the same as trend following, right? But in this scenario, instead of trading based on the naked price, you use an indicator, which is the exponential moving average indicator. In other words, we call it the EMA. So the moving average is a trend following indicator that helps you to know the direction of the trend. It looks like a ring light, right? It's a dynamic support and resistance that helps you to know the direction where the market is going. So the moving average trading strategy is very, very important because it will help newbie traders to know where the market is going. So if the price is consistently above the moving average, it means the market is in an uptrend at that period. But if the price is consistently below the moving average, it means the market is in a downtrend at that period. So what you will do is, when the market is above the moving average, you only take a buy trade when there is a pullback to the moving average. And whenever the price is below the moving average, you only take a sell trade when there is a pullback to the moving average. So that is how you trade based on the moving average. In other words, you can also trade a crossover. Crossover is when price cross above a moving average. You cannot trade in the direction of the crossover. So let me give you an example. So this is the chart. We're still on gold. This is the chart on gold. So if you want to trade the moving average, the first thing you have to do is to go to the indicator and then search for moving average exponential. And this is it. You double click on it. But for the fact I have it, I'll just open it. So this is it, right? So this is what I call the moving average, right? Once you plot it, you simply go to the settings. This is the settings, and then you configure it so that it will look nice, right? So you are using the EMA, exponential moving average. You go to the input. Then depending on the type of market, if the market is in a strong uptrend, you can use the 20 EMA or the 30, right? So for this tutorial, we are using the 30 EMA, and this is it, the 30 EMA. So we can just simply change it to 30. So we're using the 30 EMA. So the length should be 30. You can clearly see it here. Then after that, you go to the style. Here you change the color. We are using blue, and then you can increase the thickness if you wish to. This is where you increase the thickness. Then once you are done with that, you can click OK, and then the moving average is set. So now, what do you do with the moving average? It helps you to know the direction where the market is going. So you must use a moving average that the price tends to respect. So if the market is clearly in a strong uptrend, the 20 EMA is good to go. So what you do right now is you trade based in the direction of the moving average, right? Remember that the moving average doesn't work when the market is in a range, because when the market is ranging, it tends to receive so many breakouts, right? Like here, the market is in a range. That is why I have so many breakouts, right? The market is clearly in a range here, so you can clearly see there is a lot of crossover in this scenario. So the moving average works extremely well when there is a strong trend, right? When there's a strong trend, but you can still change the setting depending on how the market is. So if you feel that the market is crossing the moving average, you can simply go and change the setting. So let's just change the setting and see what happens. Let's change it to 50 and see whether if it will respect the moving average. So you can clearly see that the market is clearly in a range, so that is why it's not respecting it. So what we'll have to do is let's go back and change it to the 30 and then look for a market that is trending. That is very important. You must trade based on a trending market. So let's look for a trending market, a market that is trending. Okay, so this is an example of what I'm talking about. So now you can clearly see that the market here is trending, but the price is not truly respecting the 30 EMA. So what we'll do in this scenario is to change the period. So let's say 50. Okay, here you can see that the market is respecting the 20 EMA. So here, from here, you can clearly see that the price is in an uptrend because the prices are above the 50 exponential moving average. So this blue line is a 50 exponential moving average. So you can simply trade the breakout and the pullback. So this is the breakout. You can see here that the price breaks above the 50 EMA, which is this blue line. You can simply take a buy trade, right? Because the price is going up. So you simply enter a buy trade here. Once you confirm the breakout, you enter a buy trade here. Then your stop loss is going to be below the moving average. So your stop loss will be somewhere here below the moving average. So this will be your stop loss below the moving average, and this will be your entry. Then you can be able to ride this trend, right? Then whenever the price makes a pullback to the moving average, you also take what? A buy trade. So this is where the price makes a pullback to the moving average. You also take a buy trade here, or you wait for a rejection, right? You wait for a rejection, wait for the price to break below the moving average a little and get rejected. So if you enter a buy trade here, the stop loss should be below, a little bit below the moving average. So your stop loss should be somewhere here. This is where your stop loss should be. And then you can be able to ride this trend, right? You can be able to ride this trend. So what you are doing here, you're waiting for the price to make a pullback. Each time price makes a pullback to the moving average, you take a buy trade. And each time price makes a pullback to the moving average, you take a buy trade. Each time price makes a pullback to the moving average, you take a buy trade. So this is how you trade based on moving average. So the next strategy that we have is the support and resistance trading strategy. Support and resistance trading strategy is the foundation of all technical analysis, because every trader takes their trade from either a support or a resistance level, and that is why we call it an area of value. So what you have to do as a support and resistance trader is to wait for a price to make a directional movement to a resistance level for you to take a sell trade, and allow the price to make a directional movement to a support level for you to take a buy trade. So if you are trading support and resistance, there are different ways you can trade it. You can trade it during a trending market or during a range bound market. Now if the market is in a trend like uptrend, you only look to buy. So you buy from the lows, which is the support level. And if the market is in a downtrend, you only look to sell. You sell from the highs, which is the resistance level. But if the market is ranging, you buy from the lows, which is the support, and you sell from the highs, which is resistance. So this is the example of what I'm talking about. Let's remove this moving average line so that you get it clear. So here you can clearly see that the market is in an uptrend. So that is why we'll draw this trend line. So this trend line will be acting as a dynamic support level, right? So whenever the price makes a pullback to the trend line, we take a buy trade, right? So here you can clearly see that the market is clearly in an uptrend. So in this scenario, the trend line will be acting as what? As a dynamic support level or diagonal, because dynamic is for moving average because it changes with the market. But for the fact that this is a trend line, you have to make the adjustment by yourself. That is why a trend line is diagonal. So you only use a trend line when the market is in an uptrend or downtrend. That is if the market is trending. That is when you make use of the trend line. But if the market is in a range, you can simply make use of the horizontal line. That is if the market is clearly in a range. So what you have to do is to make out time to zoom out your chart. By zooming it out, you know the direction that the market is going, so that you can be able to look for your area of value. So this is an example of an area of value. This is an area of value, right? So this is a resistance level, and this is clearly a support level. Can you see it now? This is what we call support and resistance, right? So this is what we call support and resistance. So this is the resistance level, this is a support level, right? So the buyers are taking the buy trade from the support level, while the sellers are taking the sell trade from the resistance level. So you can see that as the price got to the resistance level here, the sellers took their sell trade, right? And their stop loss will be above this resistance level. So as the price comes down to the support level, the sellers took their profits and the buyers took their buy trade, right? So you can see that the price went up, took their take profit, and then came down again to the same support level. The buyers still enter again, and the price went up. So here is what we call the support level. So this is what we call the support level, because this is the place where buyers are taking their buy trade, and this is what we call the resistance level. This is where sellers are taking their sell trade. So this is for a range bound market, because in a range bound market, both the buyers and the sellers are in equilibrium. The buyers buy from the support and the sellers sell from the resistance. So this is how you trade the support and resistance trading strategy. Now you can see that here the price has finally broken above the resistance level and an uptrend has begun. Before, the market was in a range bound, but now there's a breakout, and now the market is in an uptrend. So you can see the market going up. So now that the market is in an uptrend, you only look to do what? To buy. You are not looking to sell anymore. You are only looking to buy. So where do you buy? You buy at the lows. So this is where you're expected to take your buy trade. So if the price makes a pullback to this level, you take a buy trade. And the price makes a pullback to this previous high, you take a buy trade, right? You can see that before this was a resistance level, and as the price broke above it, it now becomes what? A support level. So with that, you can now include your trend line, right? So your trend line will now guide you as the market is going up and then receiving support at the trend line. So this is how you trade, based on support and resistance trading strategy. So the next one we have here is what we call the relative strength index, RSI. The RSI is a momentum oscillator that measures the speed and change of price movement. It ranges from 0 to 100 and helps to identify an overbought and an oversold condition. So the RSI is what? An oscillating indicator, a momentum oscillator that helps to measure an overbought and an oversold condition in the market. So it helps to identify the speed, like when the market goes so fast to an overbought condition, you know that the market has entered an overbought, so you are looking to sell. And if the market moves sharply to an oversold condition, it means that the market has entered into an oversold condition and you look to buy. So you have to look at the speed, the time frame that it takes the price to get to that overbought or oversold condition. So the number range from 0 to 100. So when the RSI line is at 30, it means the RSI has entered into an oversold condition. And if the RSI is at 70 and above, it means that the market has entered into an overbought condition. So any level from 70 and above means overbought, and any level from 30 and below means oversold. So these are the levels that traders are looking to take their trade, right? So if the price is at the 30 level or below, you take a buy trade, or if the price is at the 70 level or above, you take a sell trade. So that is how the RSI indicator works. Let me give you an example of how the RSI indicator works. Before then, let's remove this line. So if you want to trade based on the RSI indicator, the first thing you have to do is to go to the indicator and look for RSI. Type RSI, right? So this is it, relative strength index. So you click on it and it will come out. So once the RSI is out, so this is it, this is the RSI indicator. You can simply go to the settings, look for the settings, go to the settings and do all the settings, all the configuration here. So here what you are going to do is, first you're going to remove, you know there are two lines here, so you have to remove one line so that you can work with just one RSI line. So what you do is go to the style. So this is the yellow line, you have to remove it, so you uncheck it and it is gone. You can see that there's no more yellow line there. Then this is the RSI line, which is this blue line, so you can just increase it a little, right? Or if you don't want, you can just leave the thickness the way it is. Then you can now go to the upper band, and the lower band. So you do the settings there. So the upper band, which is 70, you can make the color black. Then the lower band is 30, you make the color black. Then the middle band is 50. It depends, you can use the middle band in case if the market is trending, because if the market is trending, the price can remain at the overbought or oversold condition for a very long time. So that is when you need the middle band, which is the 50, because if the market is in an uptrend, it tends to receive support from the middle band, and if the market is in a downtrend, it tends to receive resistance at the middle band, right? So that is why if the market is in an uptrend, the price can remain at the overbought condition for a long time, and if the market is in a downtrend, the price can remain at the oversold condition at a long time. So if you are buying from the oversold condition, if the market is in a downtrend, you might get so many stop outs because the directional movement of the market is down and you are trading against the market. So that is why you need the 50 level, so that if the market comes to the 50 level, you take a sell trade, which means you are also trading in the direction of the trend. So that is why we're also going to make use of the middle band. So the middle band, we are going to make use of it. So now we have three lines: the upper band, the lower band and the middle band. So the upper band is 70, the lower band is 30, and the middle band is 50. And then this is the RSI line, this blue line. So once you are done with the setting, you click OK. So now this is the RSI line. You can clearly see the line here. So this is what I'm talking about. You can see that the RSI line clamps above the 70%, the 70 mark, right? You can see the line, this dot line is the 70 mark. So you can see that the line is above the 70 mark. So this is when you are expected to take a sell trade. So this is it. So this is it. You can see it now. So this is the RS line. So this is it. So this is where you expect to take a sell trade, because the RS line has entered the overbought condition. It is above the 70. So this is where you are expected to take what? To take a sell trade. So this is it, right? You can see the fast movement. You can see this long green candle. See how fast the candle went to the overbought condition. So this is what I'm talking about. The time rate, the speed at in which the price entered an overbought condition. That is what defines RSI. Not when the market is crawling, like you are seeing small series of small candle. When there is a sharp movement, like when the candle is very long and the RS line breaks above the overbought condition, that gives you a higher indicator to take a sell trade. So here, if you're able to take a sell trade here, you'll be able to ride this massive trend. So this is how the RSI works. So this is another one again. You can see the fast movement. You can see how long this candle is. So this is it. The RSI came very close to the oversold condition, which is the 30 mark. So this is it. The RSI is very close to it. Then you can simply take what? A buy trade. So this is it. So this is the level. This is the level. So this is the RSI, right? So this is it. This is it. So you can see that the RSI is very close to the 30. This dot line is the 30%, which is the oversold condition. So once it is very close to it, you cannot take what? Your buy trade. So the best thing you can do in this scenario is to make sure you are trading it alongside with support and resistance. Don't blindly trade the RSI indicator alone, because it's going to give you sometimes wrong signal. So that is why you need to trade it along with support and resistance. So when the price is at the support level and the RSI line is at oversold condition, this gives you a perfect entry. If the price is at the support level and the RSI line is at the oversold condition, that gives you a perfect entry. You have double confirmation. But if the RSI is at the overbought condition, which is above 70, and price is at the resistance level, you cannot take a sell trade, because this gives you a perfect confirmation to enter a sell trade. So this is how you trade based on RSI indicator. Like I said, you need to trade it alongside with support and resistance, because trading it alone might sometimes give you a wrong signal. So if you want to get the perfect entry, trade it along with support and resistance. Like I said, if the RSI line is at the oversold condition, that is below the 30, and price is at the support level, it gives you a double confirmation to take a buy trade. And if the RSI line is above the 70 mark, that is at the overbought condition, and the price is at the resistance level, it gives you a double confirmation to take a sell trade. So this is how you trade based on the RSI indicator. So these are the 5 top trading strategy that newbie traders should master. If you master these 5 trading strategy, you'll be able to make money consistently in the forex market. So I'm not saying you should go and learn all of them. Just pick one from these 5 trading strategy and master it. Like I said, we have the trend following strategy, we have the breakout strategy, we have the moving average strategy, we have the support and resistance strategy, and we have the RSI strategy. So pick one from these 5 strategy, master it, backtest it, and once you are making profit with it, that is it, you are good to go. Then you cannot combine it with your money management and risk management and your trading psychology. Remember that strategy alone cannot give you everything you need, so you need to add it up with money management, risk management, and the right trading psychology. When you combine this together, it gives you a perfect trading plan, or should I say a perfect trading strategy that will help you to become profitable in the forex market. So ladies and gentlemen, that is all I have for you in this video. I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel for more educative content like this, and also don't forget to turn on the notification icon to be the first to be notified whenever I drop new content. I will see you again in my next update. Enjoy the rest of your day. Bye.